Atocha Global Analytics. Please like and subscribe.
Greetings, salutations, and howdy to you all. I'm KT with Atocha Global Analytics. Atocha Global Analytics was created to provide insight and foresight into the street-level impacts of macroeconomics, real estate and finance trends, and the policies that shape them. Okay, so here's a topic I've been wanting to refocus on again for a while. It's Forecast Friday. So there are hundreds of financial and economic metrics that economists and business leaders can use, but many are very segmented and esoteric for general use. Also, many of these metrics are actually lagging indicators. They may be presented as fresh and new when they're released, but the data tends to and the trends can be foreseen through other inputs. So I'm going to go through and highlight these 45 metrics that I've selected for inclusion in Forecast Fridays. Though all of them are useful for trend forecasting, many are indicators of trends before they even ripple through the economy. Here's some examples of that premise. If trade is slowing, there are measures of that in orders and transportation. You know, the point of sale is the last stop in the retail chain, but we can track volumes going back up to the point of origin. You know, if business, real estate, or trade cycles are changing, there are a number of ways of measuring this before it actually hits the monthly stats. You know, trends in trade can be foreseen via changes in demand for transportation, packaging, and shifts in spending. Trends in business cycles can be foreseen via employment, bankruptcies, and financial conditions. Real estate cycles are closely tied to economic and financial conditions, so changes in key metrics are very reliable for forecasting short and midterm trends in real estate as well. So expanding on this idea around real estate just a bit, when the Federal Reserve began to raise rates in early 2022, many real estate prognosticators began forecasting that housing sales would slow and prices would fall. Well, it seems like common knowledge now that there would be a shift, but many agents and brokers in the real estate field seem to continue to talk about how the fundamentals were strong and the market would stay up. Well, that has been true in some areas of the northeastern and midwestern U.S., but parts of the South and West are seeing noteworthy declines. I want to point out that a number of experienced, and by experienced, I mean truly seasoned real estate professionals, professionals who invest money in real estate, they foresaw these changes and acted in 2021 before the downturn hit. Matter of fact, I just did a video series entitled Professional Investors Real Estate Success Story, where I highlighted a property I'd modeled first in 2013. It was sold in 2017 and resold again in the latter half of 2021, and it nearly tripled in value over those 8 years. So when you look at everything that was involved, you can see that the seller timed the 2021 sale just right. How? Because they understood what I cover here in this video. However, though this isn't just about real estate, it's about the economic drivers in general and the many things that contribute to the economy. But we need to address that since real estate is a huge part of the economy for everyone as well. So first, let's get in a time machine, step back for a moment and review where we were in 2021. Housing prices were skyrocketing, going up huge. But they moderated quickly in 2022. Note that I didn't say drop about the real estate prices. I said moderated. This was a rather abrupt market shift. Now, if you fast forward to now, our current 2023 housing market completely detached from fundamentals in many areas because of the rapid change. So yes, it's fueled by sharp increase in mortgage rates. Yes, there's going to be a correction, and yes, all these are so true as to be obvious statements at this point. However, what that correction will ultimately look like is still an unknown. It could be price declines, rate declines, wage increases, macro inflation eroding housing unaffordability over time, or a drastic reduction in new housing construction that shifts supply and demand to support these higher prices. Or if, as a matter of historical perspective, likely a combination of most of them. So diving back into Forecast Friday specific things, and we shift back into the forecast metrics, please like and subscribe. So as this is Forecast Friday, this is a reintroduction to the weekly segment that will track these 45 plus metrics and provide a snapshot of the economic trajectory and real economic activity that we see. I say real economic activity because not all measures of economic activity are a reflection of reality. I know that many viewers of this video may not necessarily be familiar with Keynesian theory, so I'll note this. Remember, U.S. government spending is a component and a measure within GDP, and so increases in government spending push GDP up. When government spending declines, not only will people be surprised at the concept of that, but they will think, hell is iced over or something. But when government spending declines, GDP will soften then as well. So here's the three tables showing various metrics. I will be highlighting things, but I've intentionally randomized their order, by the way, as sector recessions are a factor. And I think there are some interesting, unique metrics that I wanted to disperse across the three tables as well. By the way these metrics apply, or the data is made available, means that some of the time periods vary. What applies to these different metrics vary. Some are weekly, monthly, quarterly, semi-annually, or annually. Most have 3 periods that we can focus on, but some are less. They're all color-coded for reference, whether it's weekly, monthly, or quarterly, and with a few outliers which are not coded but denoted in the description. Also, on the right-hand side of these tables, each individual measure is color-coded red or green. Whether the item goes up or down is coded based on how it benefits or hurts the economy. Good is for green, red is not good for the economy, so it's very intuitive that way. So the first line item on the first table is obvious. Consumer spending is down monthly, quarterly, and annually. Not down huge, but enough to make a difference. The second item is the Baltic Exchange Dry Index. This measures international shipping, the container ship demand, pricing, etc. So it's down big annually, up a little bit quarterly, but down weekly. In a consumer-led economy, shipping traffic means trade, which is down. Next is the U.S. monthly rail traffic. This often falls in the second half of a recession, but it is down a bit across the board already. So, by the way, shipping out of China to mature markets is down huge. So that is noted there. Rhetorically, what does that mean, by the way? It means that we will... either we'll have shortages, which would drive up prices, meaning more inflation, or demand is down. The next one is domestic trucking, showing a bit of softness there. However, then you see the retail index is fairly flat. So here's some quick analysis of what that means. Inventories got too high and spending didn't burn through it fast enough coming out of the lockdowns, and the shortages that we suffered. Business had curtailed their inventory acquisitions, until this all moderates. So, so this is due to a slowing economy and the previous shortages causing these distortions. It doesn't mean that economic sky will fall necessarily, but it also means that the economy is slowed and is not expected to pick up too soon or not at least in the foreseeable future. Other items are important here as well. The 2 to 10 year Treasury spread is a short-term item that has been signaling a recession really for months, to the point of a severe recession. Something that construction spending is a big factor in the economy. Building permits are relatively flat, which is good economically. Durable goods are soft on average. By the way, oil is a huge factory in economic health. Energy production, manufacturing, transportation, packaging, all of these require oil. And as oil goes, so goes the economic health via an inverse relationship. So the current price and quarterly price are shown, highlight where we've come from or where we are, at least come from recently. But the annual is a forecast. All right. So the annual forecast is shown really as that is where markets think demand will drive pricing. So soft pricing forecasts here mean a slow to moderate economic forecast and stable international conditions. The Philly Fed Manufacturing Index is still a very important measure of economic activity, despite the manufacturing sector having a smaller segment of the economy. And the manufacturing sector has not been doing well. Same with the ISM Purchasing Managers Index. Both are below parity and well into recessionary ranges. By the way, please, view the table overall here before I change, and note that the red vastly outweighs the green on this particular table. So, and as we shift into the second table of the forecast metrics, please like and subscribe. Thank you so much. The next ones here are retail and real estate oriented here, or retail real estate oriented. Occupancy has dropped slightly, but is still quite high. That's a good measure for seeing that businesses are still engaged. And retail rental rates remain solid. So again, that's solid. Now, capitalization rates are increasing, but that is also tied to the interest rates increasing. So, the interest rates going up creates stress on the market and the finance systems. By the way, mortgage applications are down huge annually, but benefited from a late season bump. That's been in the news, so that's not anything too noteworthy. Here's another prescient metric, the cardboard box index. Most of what ships, anywhere, whether it's your food, your clothes, your appliances, these things all have to ship in cartons before it gets to the store shelf or the showroom or whatever. Cardboard boxes, the index is way down, meaning the volumes are down. And this dovetails with transportation metrics we'd already looked at with the Baltic Index and what have you. All right, weekly hours worked are down, and initial claims are up until the last month anyway. These are showing a gradual erosion of the labor market. Two more manufacturing areas are shown below that. They're soft, but these are more broad in their impact than the ones we looked at earlier. Mortgage delinquencies and foreclosure stats are actually looking okay right now, but foreclosures overall have been up recently. The issue here is some distortion in the, because of the moratoriums and the end of those moratoriums, it caused a spike in foreclosure activity. So it means the annual numbers are skewed, but actually they are higher than foreclosures and mortgage delinquencies are up from what they were. It just doesn't necessarily show the way the data is expressed. Auto loan delinquencies are increasing, but suffer similarly from the skewed annual figures as well. Consumer confidence index shows volatility throughout, but indicates a softening in most recent month. The leading economic index is continuing its slide, which means things aren't looking all that rosy. And these are supposed to be leading economic indicators, so they're forward-looking. Overall, a fair amount of red is shown on this table too, so I want to make that note here. The third and final table here, so again, please like and subscribe as we move into that one. Money supply is a big factor with expansion or contraction in the economy following the monetary policy. So monetary supply contracting is tightening the financial conditions, which is a slight drag on the economy. So it's a slight drag at present, but it is increasing. Industrial production is slowing after a rebound. Efficiency and productivity has been softening as well. Retail is way off in a year, yet GDP is chugging along. So those seem to be contradictory. The next three are large sector measures that show a kind of a mixed bag. Consumer expectations right now, by the way, are looking great, but that may be partly tied to inflation softening post-lockdown, the psychological recovery from that. And now, let's shift to some more interesting metrics here. The global leading economic indicators, that index is down. G20 is also down slightly. The U.S. coincident LEI, leading economic indicators, is actually up. But that is, again, very forward-looking. So this looks fairly good, but it also seems a bit contradictory to other things like transportation packaging metrics that show things slowing. So an oddball but handy metric is UPS parcel values showing a slowing trend. Lastly, let's look at some this bankruptcy filings. All these are up, but they were quite soft during the 2020 time frame because there were so many things that were kind of nullified during the lockdowns. So the trend is not our friend with bankruptcies, but they are pushing towards critical thresholds. They just haven't quite reached them yet. Please note again On this table, we have more red than green, maybe not as overtly negative as the previous was overall, but they are a bit more red than green. And before I spend 2 minutes to summarize the domestic and international perils we face, one last time, please like and subscribe. Appreciate that. Okay, so that was a lot of metrics, but it is important to note that the U.S. is dominant in many ways, but that doesn't mean it's entirely immune to international problems. You know, there's issues in other noteworthy economies, and they can cause problems here. For example, China real estate is reported to be a dumpster fire right now. Its values had gotten too high, and the government had, they've actually started demolishing completed buildings because they massively overbuilt. The construction was a plus for their economy, and the increasing values were a plus for their economy, but it's reached a bit of a tipping point. Europe right now is also fairly hard pressed. And that's for a variety of reasons, with Ukraine actually being a smaller factor than we might have foreseen a year ago. And Britain specifically is, definitely struggling post-Brexit. Of course, Britain's exit from the EU hasn't been handled all that well. All the trade tax benefits Britain lost could have been supplanted with agreements that would have mitigated some or all of the adverse impacts of Brexit, but that doesn't seem to have happened. Seems like somewhere between unintended consequences and voter coercion to me, but I'm not an expert on Britain's politics. Regardless, whether it's the EU, Britain, China, these mature economies, there are potential factors that can shape our economic reality, and they shouldn't be ignored. So this segment, Forecast Friday, it became a bit more involved than intended this time, but next week's video will highlight what changes have made, may reinforce some of the reasoning behind choosing these items, but it will be a little bit more streamlined. By the way, if you believe something is worthy of being on the list, please suggest it in the comments. I thank you for joining me today and look forward to catching you next week for Forecast Friday.
Atocha Global Analytics was created to provide insight and foresight into the street-level impacts of macroeconomics, real estate and finance trends, and the policies that shape them. What is happening in the financial world today shows us that those of us on Main Street are in a street fight for our financial futures. In order to win this fight, we need to become truly streetwise.